All right. Joseph, Esther, and Farida, you're most welcome to our session. Just confirm once again. Joseph has already confirmed that he can hear me. Esther and Farida confirm that you can hear me in the chat box. All right. Thank you very much for the confirmation. So also confirm that you can see my screen. Are you able to see the screen? All right. So today we are looking at property, plant, and equipment. Just to give you a run through, this standard is one of the most important standards in financial reporting. So your number one will have many scenarios that are referring back to property, plant, and equipment. It can be brought as a number on its own in section B. So you encounter scenarios that require knowledge of property, plant, and equipment very often. So I ask you to really pay attention and note whatever you have to note. So we are going to look at, just to give you a run through, we shall look at the definitions as usual, measurement and recognition, subsequent measurement, depreciation, derecognition, impairment, and of course, as usual, the disclosures for the standard. So let's quickly look at the scope of this standard. So just to give you a brief before we go to the summarized notes that I'm going to share with you. This standard just generally recognizes, it helps you recognize assets in your financial statements or your books of account. And we shall see determination of their carrying amounts, depreciation charges, impairment losses that are related to these assets. So we are going to look at all those terms and how they come into play as far as property, plant, and equipment is concerned. So the scope, according to the standard IAS 16, should be followed when accounting for property, plant, and equipment, unless another international accounting standard requires a different treatment, which we shall see, or we are going to see briefly. So basically, when you hear IAS 16, the first thing that should ring in your mind is property, plant, and equipment. And from the financial accounting knowledge that we have, property, plant, and equipment normally is found on the financial statement, our balance sheet, or the statement of financial position under assets, but specifically non-current assets. So all that should be playing in your mind when you're interfacing this standard. However, IAS 16 does not apply to the following. Kindly note what this standard doesn't constitute. A, non-current assets held for sale and discontinued operations. I think it was discontinued, the word. So there are some non-current assets. For example, if I have a shop and I buy some goods, which we looked at in inventory, though not all inventory is under non-current assets. But for example, if I buy like which assets can I use? I'm dealing in electronics and I buy maybe kettles, flat irons, and they are held for sale. That is not accounted for under IAS 16. So as you're recognizing in your books of accounts, don't put it under property, plant, and equipment, IAS 16. Then 2, biological assets related to agricultural activity. That is looked at in the standard IAS 41. We shall look at it separately. The biological assets or agricultural activities. We are going to look at it separately. So sometimes people have biological assets like their trees, which are planted or grow for over a long period of time, years, very many years. You have your cows, you have maybe other animals. Please don't be tempted to account for it under this standard. They have their own standard. Then exploration and evaluation assets. Exploration and evaluation assets. That one we shall look at it under IFRS 6. Then also mineral rights and mineral reserves such as oil, gas, and other non-regenerative resources. So you may be given a scenario where they've included all this, a bit of property, plant, and equipment, but they've also given you scenarios of maybe a biological asset or maybe exploration and evaluation asset. So you have to be in position to identify what falls into this particular standard and what falls into other standards. But there is a note, however, the standard applies to property, plant, and equipment used to develop these assets. For example, if I have a farm, and I'm rearing these cows and I have maybe milking equipment, that milking equipment, or if I have a farm and I dig and I have a tractor, that tractor is accounted for under property, plant, and equipment. Same for the exploration and evaluation assets. If I have maybe a mine and I'm using some machines to mine these resources, those machines are valued under property, plant, and equipment. Hope everything is clear up to this point. So we are going to look at the key definitions in this standard. And I ask you to note them or summarize them accordingly, because you will interface these terms. But actually, as you present also your answers, you have to be able to show the examiner that you understand the standard. So you may need to, at the beginning of your answers, to define certain terms before you answer the question. So it's good to have these definitions with you. But also when you understand them, it will be easy for you to interpret the scenarios given to you. So number 1, the carrying amount is the amount at which an asset is recognized in the statement of financial position after deducting any accumulated depreciation and accumulated impairment losses. So basically, it is what is left of the asset, the value that is left of the asset. That is the carrying amount. And we shall look at it in a practical way through a calculation. So it is indicated in our statement of financial position. That amount that you find maybe in a statement, you see property, plant and equipment, the amount they put there, that is the carrying amount of those assets. Maybe the carrying amount of the land, the carrying amount of furniture and fixtures. Then two, costs is the amount of cash or cash equivalents paid or the fair value of the other consideration given to acquire an asset at the time of its acquisition or construction. So simply, cost is, as you hear it, I go into maybe a factory to purchase a machine, whatever I pay for that machine is the cost. Though some scenarios, I may not pay cash, I may give in a cash equivalent. So the amount that cash equivalent is estimated to be is the cost, or the fair value of the other or whatever consideration. There may be some sort of exchange where I've not transacted in cash. So whatever amount is estimated at that moment is what I take as the cost of the asset. Through acquisition, but also in construction. For example, if I'm constructing a building, the cost that will come from the process of constructing that building is what I recognize as cost in my books of account. Then depreciable amount is the amount of an asset or other amount substituted for cost. Sorry, is the cost of an asset or other amount substituted for cost less its residual value. So the residual value is basically the what value remains of the asset. So when that difference between the cost and the cost of the asset and the residual value is this depreciable amount. Then depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. So we all know from financial accounting what depreciation is, and we shall look at it extensively later on in the session. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. And we can look at it more in IFRS 13. So fair value is, I can just term it as market value. What is the value of that asset in the market currently? Or if you're to sell it, what would they give you? So that is the fair value. But the definition according to financial reporting, which you need to note, is it is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. The other term is an impairment loss. Please take note of all these definitions because they are going to resurface as we move on. So if you've not understood them well, you will face challenges in giving explanations as we move on. So an impairment loss is the amount by which the carrying amount of an asset exceeds its recoverable amount. So we've already looked at carrying amount. That is what is written in the books. Then also, we are going to look at the recoverable amount. So now they are telling us that an impairment loss is the amount by which the carrying amount of an asset exceeds its recoverable amount. For example, if in my books, my carrying amount is 10,000, and when I go to the market, recoverable amount is 5,000. So the difference between 10,000 and 5,000 is what impairment loss is. That the impairment loss is the 5,000. And we shall see how we treat it in our books. The other definitions, there is property, plant, and equipment. And those are tangible items that, please note the word tangible items that are held for use in the production or supply of goods or services, for rental to others or for administrative purposes, and are expected to be used during more than one period. So for an asset to be recognized as property, plant, and equipment, number one, it has to be tangible. Tangible means it can be touched, it can be felt, it is not in space. You can see it, you can touch it, you can feel it, it is tangible. That is number one. Then the other is it has to be held for use in the production or supply of goods or services. So that eliminates what we have seen before, those items that are bought for resale. We don't want them in this standard. So we only want items that are held for use in the production or supply of goods or services. Then also we can have those tangible items or property and plant and equipment for rental to others. For example, I can have my cars that I rent out, or I can have buildings that I rent out. Or for administrative purposes. They are used in the daily operations of business, like computers and whatever machines that sometimes are used for administrative purposes. But the other thing to note is we expect them to be used during more than one period. That takes us back to the fact that these are all non-current assets because they are used for more than one period. Because current assets are used within a period, that one period. So any assets that are used beyond one period, we refer to them as non-current assets. The other term we are going to look at is useful life. Useful life is the period over which an asset is expected to be available for use by an entity, or the number of production or similar units expected to be obtained from the asset by an entity. So basically, it is an estimate of how long this asset is going to be available for use. Or for example, in terms of production, if it is supposed to be producing for us, maybe the machine is making books and it is supposed to produce for us over 10,000 books or 20,000 books for the period, it will be useful to us. That's how we are going to determine its useful life over time. So when it starts, when the number of the production decreases, we are at a point where we are recognizing that its useful life is going down. But also where it doesn't fulfill the estimated useful life, we shall see how we shall treat that in our books of accounts. So basically, that is what useful life is. Hopefully we are together up to this point. The standard has many definitions, and it's key that we understand them. So let's continue. We've already seen recoverable amount. Let me just go back. We said impairment loss is the amount by which the carrying amount of an asset exceeds its recoverable amount. So at this time, we are going to see what recoverable amount is. Okay. So recoverable amount is the higher of an asset's net selling price and its value in use. The higher of the asset's net selling price and its value in use. So how do we get the net selling price? Net selling price is fair value. That is what you're given on the market. For example, if I'm to sell the asset at this particular time, how much am I given? That is the fair value minus the costs to sell. For example, if on market, the fair value is 2 million, but I'm going to incur cost to sell of 500,000. So my net selling price will be 2 million minus 500,000, giving me 1.5. So that's then the value in use. The value in use is basically what we've calculated before. Just to go back, value in use is what we've calculated as far as the asset is concerned, its useful life. What are we getting out of it? What is the entire cost or the entire amount from its use? What are we projecting to gain from it? It's basically that. So the higher, whatever, if the net selling price is 1.5 and the value in use is 1 million, we take the 1.5. If the net selling price is 1.5 and the value in use is 2 million, we take the value in use as the recoverable amount. So the higher is what we take. The residual value of an asset is the estimated amount that an entity would currently obtain from disposal of the asset after deducting the estimated cost of disposal if the asset were ready, of the age, and in the condition expected at the end of its useful life. So specifically, this is you've used the asset and you know it is done, its period, its useful life is done. So whatever amount we are estimating to get from that asset minus any costs of disposal is our residual value. Then entity specific value is the present value of the cash flows an entity expects to arise from the continuing use of an asset and from its disposal at the end of its useful life, or expects to incur when settling a liability. So we shall see scenarios where we have to project the cash flows that are going to come from an asset. For example, I gave you an example. If we are expecting a machine to produce maybe 20,000 books, we quantify that into amounts of how much are we going to be selling each book. So whatever cash flows we are expecting from that, and from the continuing use of that asset is the entity specific value, what we calculate internally. So hopefully we are together before we move forward. The standard is quite wide. It has many definitions, but the more you will practice, the more you will get acquainted with them. So we are going to look at how we recognize property, plant, and equipment in our books of accounts. What does the standard tell us? What should we do? What should we put into consideration before we recognize? So recognition refers to incorporation of the item in the business's accounts, in this case, as a non-current asset. So I've already talked about that property, plant, and equipment is found in your statement of financial position under assets and specifically non-current assets for reasons we've seen. Number one, they are tangible. Number two, used for more than one period. Then number three, just to take you back, is they are used in the production or supply of goods or services. So you need to have that in mind, because these things are not going to come as straightforward as we are seeing them here as we are going through them. They'll bring you the scenarios, they'll bring you the statements, and at that point you're using this knowledge to make your to give your answers and to make your adjustments in the statements and to give the right solutions to the examiner. So an item of property, plant, and equipment shall be recognized as an asset if and only if it is probable that future economic benefits associated with the item will flow to the entity, and two, that the cost of the item can be measured reliably. So the definition of an asset in whole, all assets, is we expect, in the definition of assets, is that we expect a future economic benefit to flow towards the entity. We are not expecting any losses. We are not expecting any liabilities or any expenses. This asset, something to be termed as an asset, it is bringing a benefit into the business or the organization, in whichever way it is doing that. So that is the number one condition, that the property and plant equipment shall fulfill to be recognized. Then number two, if we can measure the cost reliably, they can give you scenarios that the machine is there, but you can't trace back how it was bought, how it came into existence. So we need to have certainty of measurement of the cost of that item. So these recognition criteria apply to subsequent expenditure as well as costs incurred initially. There are no separate criteria for recognizing subsequent expenditure. So even as we measure subsequently, we need to have those conditions also in mind. Property, plant, and equipment can amount to substantial amounts in financial statements, affecting the presentation of the company's financial position and the profitability of the entity through depreciation, and also if an asset is wrongly classified as an expense and taken to profit or loss. So they are trying to bring to us the importance of this standard and knowing how to recognize property, plant, and equipment. Because normally property, plant, and equipment costs the company or business a lot of money. So if we recognize it wrongly, it will affect financial statements. For example, on your profit, your statement of financial position, if you calculated your carrying amounts of your assets and they are lower, the value of your assets are lower, someone, maybe an investor or the stakeholders look at that statement of financial position, they will be, these guys are not performing well. They are not performing well. But also where you mistakenly cost of property, plant, equipment, and profit or loss, it will increase your expense and decrease your profit. Because remember, the amounts are substantial, thus affecting your profitability. They'll be like, these guys don't make profits. They are just to waste time. But also for tax purposes, if any of you have done taxation or that's why we have allowable deductions in taxation to make these adjustments accordingly. So as an accountant for organizations and business, you have to be keen on this. You have to advise your bosses on how best to recognize these assets in your books, because the temptation to recognize them as expenses, especially for tax purposes, is very high. So, but at the end of that day, they affect your financial statements. That's what this particular point is trying to bring out. So in recognition, we are going to look at the first criterion, which is the future economic benefits. The degree of certainty attached to the flow of future economic benefits must be assessed. This should be based on the evidence available at the date of initial recognition, usually the date of purchase. The entity should be assured that it will receive the rewards attached to the asset and will incur the associated risks, which will only generally be the case when the rewards and risks have actually passed to the entity. Until then, the asset should not be recognized. So at the point of acquiring this asset, for example, before I go out to buy land, there is some benefit that I'm expecting from this land. I have to have estimated that. So this is what the point is bringing out, that for us to recognize this property, plant, and equipment, first of all, we have to ascertain the flow of future economic benefits. Is it going to benefit us, or we are going to just have something that is seated there and giving us anything in return? So where it is not identified, we are not going to recognize that as property, plant, and equipment under our assets. So the second criterion, cost measured reliably. It is generally easy to measure the cost of an asset as the transfer amount on purchase, i.e., what was paid for it. Self-constructed assets can be measured easily by adding together the purchase price of all the constituent parts, labor, materials, etc., paid to external parties. So this one is normally easy. what have I paid for this asset, or what have I incurred in putting this asset, or making sure that this asset is set up, or constructing this building, or setting up this machine. What have I incurred? So we are going to look at at separate items. There are scenarios where you have separate items. Most of the time, assets will be identified individually, but this will not be the case for smaller items such as tools, which are sometimes classified as inventory and written off as an expense. Major components or spare parts, however, should be recognized as property, plant, and equipment. For very large and specialized items, an apparently single asset should be broken down into composite parts. This occurs where the different parts have different useful lives and different depreciation rates apply to each part, e.g., an aircraft where the body and engines are separated as they have different useful lives. So this particular point is trying to bring out cases or scenarios where we have one asset, but with different components that are very huge and major, and they have different useful lives, and they are depreciated differently. So we have to recognize each on its own. So they've given us a very good example of an aircraft. There is also safety and environmental equipment. This may be necessary for the entity to obtain future economic benefits from other assets. For this reason, they are recognized as assets. However, the original assets plus the safety equipment should be reviewed for impairment. So safety and environmental equipment, I can give an example of a factory. Most factories, they are expected to put up safety equipment and environmental equipment. For example, pollution control equipment, fire control equipment, safety barriers in factories. For example, barriers where you find like, don't go beyond this point. So they are not actually used in the production process, but they facilitate the production process. So we also recognize them, and also we review them for impairment, depreciate them separately in this standard. Just confirming the chart if we are together up to this point. If I go on to the next slide. Are we together? All right, thank you very much. So we are going to look at measurements. We've just concluded recognition. We are going to look at the measurement of property, plant, and equipment. So we have two stages of measurement. So we are going to look at the initial measurement of property, plant, and equipment. Once an item of property, plant, and equipment qualifies for recognition as an asset, it will initially be measured at cost. So remember, our recognition of the is we have determined that there is future economic benefits flowing to the entity, and number two, its cost is measured. It can be measured reliably. So we've recognized it as an asset. So now we are starting to measure it. So initially, we are measuring it at cost. Now let's look at the components of cost. What are we considering under cost? Cost comprises of the following. Number one, purchase price, less any trade discounts or rebates. Under inventories, we looked at rebates and trade discounts. Rebates are basically, you can buy an item and you pay for it, then the supplier or vendor will return some amount just to retain you as a customer. So those rebates also, we less them from the purchase price. Import duties and non-refundable purchase taxes. Directly attributable costs necessary to bring such an asset to the location and working condition for its intended use. So we are going to look at all this in detail. Measurement of costs. The cost of an item of property, plant, and equipment is the cash price equivalent at the recognition date. I think that one we've talked about it and I have emphasized it over and over again. So let's look at examples of directly attributable costs. Directly attributable costs are, number one, costs of site preparation. Maybe there is this machinery you're bringing in and you have to prepare the place where you're going to place it. So that cost of site preparation. Or you're constructing a building and you have to prepare the site, remove the stones, all that. Two, initial delivery and handling costs. Three, installation and assembly. Costs. So you may get this. Sorry about that. Let me just repeat the statement and reshare my screen. My internet went off for some time. So we're looking at measurements, attributable costs, directly attributable costs, costs of site preparation, initial delivery and handling costs, installation and assembly costs, costs of testing whether the asset is functioning properly, after deducting the net proceeds from selling any items produced while bringing the asset to that location and condition, such as samples produced when testing equipment. So what the statement is trying to mean is Sometimes the machines or whatever, the property, plant and equipment, we have to test it before it starts functioning. So in that process of testing it, we may produce some goods or some products. So if we sell them off, the net proceeds from selling those items, we shall deduct them from that cost. Then whatever cost that we have incurred in making sure that this property, plant and equipment is functioning properly, after lessing whatever proceeds we've gotten from maybe the products we have, the samples we've made, we consider that as a directly attributable cost to the cost of the property, plant and equipment. The other is professional fees. You can be setting up your property, plant and equipment and you don't know how to use it, and you have to bring in professionals to help you, maybe set it up, install it or what, and you have to pay them some money or to teach your employees how to use it, train them. Costs of employee benefits arising directly from the construction or acquisition of the item of property, plant and equipment. Maybe you've paid any bonuses or allowances to employees as you're constructing or acquiring this property, plant and equipment. Also that cost that is specifically going to that item is what you have to consider, not the general allowances and bonuses in your business. Then the other, initial estimates of the unavoidable costs of dismantling and removing the asset and restoring the site on which it is located. So whatever estimated costs, additional estimated costs or unavoidable costs that are attributed to this property, plant and equipment. So we need to note, directly attributable costs are determined after deducting the net proceeds from selling any items produced when bringing the asset to its location and condition. Then number 2, income and related expenses of operations that are incidental to the construction or development of an item of property, plant and equipment should be recognized in profit or loss. So these are not directly attributed, they are just incidental. So we shall just recognize them as usual under our operating expenses or under our income, now profit or loss statement. So let's look at examples of costs that are not costs of an item of property, plant and equipment. So we've looked at the attributable costs. Now we are going to look at those examples that are not costs. The other ones were, these ones are not. 1, costs of opening a new facility. That is startup and pre-production costs. 2, costs of introducing a new product or service, including costs of advertising and promotional activities. 3, costs of conducting business in a new location or with a new class of customer, including costs of staff training. And administration and other general overhead costs. Then also initial operating losses before the asset reaches planned performance. So the standard is trying to help us look out for those costs that we might mistakenly include in property, plant and equipment. So these are the examples of the costs that we have to recognize. So take note that These are the tricks the examiner will use in scenarios. They will give you costs that are not supposed to be recognized under property, plant, and equipment, and costs that are supposed to be recognized under property, plant, and equipment. So if you didn't understand them well, if you didn't grasp them well, you will confuse that too, and you will compute the cost of the property, plant, and equipment, which will not be right. So we need to put all this into consideration and note them seriously. Then the other thing to note, all the above costs will be recognized as an expense rather than an asset. So all those other costs that we've seen above here, cost of opening a new facility, cost of introducing a new product or service, cost of conducting business in a new location, administration and other general overhead costs, initial operating losses before the asset reaches planned performance, we shall recognize them in our profit or loss as expenses. In the case of self-constructed assets where an entity constructs its own buildings, the same principles are applied as for acquired assets. If the entity makes similar assets during the normal course of business for sale externally, then the cost of assets will be the cost of its production under IAS 2 inventories. We looked at that under inventories. So if the construction of this asset is, the assets are meant for sale, that is inventories. If I'm constructing houses or apartments for sale, I'm not going to count that cost under my assets, property, plant, and equipment, sorry. It is going to be under inventories. Then also, we need to note that abnormal costs or wasted material, labor, or other resources are excluded from the cost of the asset. So also the examiner can give you those same scenarios of wasted material, abnormal labor, and other resources. So you need to be able to recognize that these are not part of property, plant, and equipment. So I told you there are two measurement processes. So we've just finished the initial measurement, which is at cost. Now we are going to look at the subsequent measurement. Subsequent means after. The other one is at the beginning. Now, after, what do we do? How do we continue measuring this asset, this property, plant, and equipment? So subsequent expenditure. Such costs should be added when it is probable that future economic benefits exceeding the original standard of performance will flow to the entity. Initially, we recognized that we are going to try to estimate the future economic benefits of this asset. So later on, we can recognize that actually we underestimated the economic benefits. There is more we can gain from this asset. So that's what this particular statement is meaning, that we can add these costs if it is probable that future economic benefits exceeding the original standard of performance will flow to the entity. And also, like before, that they can be reliably measured. The cost of major inspection or overhaul occurring at regular intervals is capitalized where it is identified as a separate component of the asset and the replaced components are fully depreciated. So you remember we looked at separate items. So sometimes machinery may be inspected over time, or what is it called? They have to be serviced and the cost is quite big. So this is a cost that they are trying to bring into consideration. So there is also a scenario where there can be exchange of assets. IAS 16 specifies that exchange of items of property, plant, and equipment, regardless of whether the assets are similar, are measured at fair value, unless the exchange transaction lacks commercial substance or the fair value of neither of the assets exchanged can be measured reliably. If the acquired item is not measured at fair value, its cost is measured at the carrying amount of the asset given up. So if there is an exchange of assets, definitely in your books, your asset has that carrying amount, your property and plant and equipment has that carrying amount. So the property, plant, and equipment or asset you're exchanging with has a fair value amount. So right now we are going to recognize it at fair value. But where that exchange is happening and there is no, the item that is coming in that you're exchanging with doesn't have fair value amount, we shall take the carrying amount of the asset that we are giving up. Expenditure incurred in replacing or renewing a component of an item of property, plant, and equipment must be recognized in the carrying amount of the item. The carrying amount of the replaced component of an item of property, plant, and equipment is identified in respect of a major inspection to enable the continued use of the item. So for example, if there is a cost that has been incurred in inspection or servicing or replacing a certain component, we add that cost to our carrying amount. Measurement after recognition. An entity shall choose either the cost model or the revaluation model as its accounting policy and shall apply that policy to an entire class of property, plant, and equipment. So we are going to look at the classes of property, plant, and equipment. So what the statement is trying to mean here is the standard requires us to choose either cost model or revaluation model. Don't mix for a particular class of property, plant, and equipment. So let's look at cost model and revaluation model, the definitions. Cost model, after recognition, an item of property, plant, and equipment shall be carried at its cost, less any accumulated depreciation and any accumulated impairment losses. So it is that simple. Cost of the item minus depreciation, accumulated depreciation, and any accumulated impairment losses. Revaluation model, after recognition of an item of property, plant, and equipment whose fair value can be measured reliably, shall be carried at a revalued amount, being its fair value at the date of revaluation, less any subsequent accumulated depreciation and subsequent accumulated impairment losses. Revaluations shall be made with sufficient regularity to ensure that the carrying amount does not differ materially from that which could be determined using fair value at the balance sheet date. So basically the revaluation model is using the market value, the fair value of the property, plant, and equipment. At that particular time, as you're measuring using revaluation model, you have gone to the market and recognized what this asset can cost. Then you less any subsequent accumulated depreciation and any accumulated impairment, subsequent accumulated impairment losses. Though you have to be careful that this amount does not really differ so much from your carrying amount. They are quite close, not very different. If an item of property, plant, and equipment is revalued, the entire class to which that asset belongs shall be revalued. A class of property, plant, and equipment is a grouping of assets of a similar nature and use in an entity's operations. So these are the classes we have, the examples. We have land, buildings, machinery, ships, aircraft, motor vehicles, furniture and fixtures, and office equipment. So, for example, if I revalue a piece of land, it is incumbent on me that as an accountant or as an entity to revalue all the other assets that are under that particular class of land. Or buildings, if I've revalued one, all have to be revalued. Motor vehicles, all have to be revalued if I've decided to revalue them. The market value of land and buildings usually represents the fair value, assuming existing use and line of business. Such valuations are usually carried out by professional valuers. In the case of property, plant and equipment, fair value can also be taken as the market value, where a market value is not available. However, depreciated replacement costs should be used and there may be no market value where types of plant and equipment are sold only rarely or because of their specialized nature, i.e., they would normally only be sold as part of an ongoing business. So what the standard is trying to indicate here is some scenarios, the fair value of plant and equipment is not clear in the market. So in that case, you'll use depreciated replacement cost. So briefly, just if you have where to write, depreciated replacement cost is basically what that asset would cost you when you bought a brand new item, exact item. For example, if it is a car, a vehicle, you bought maybe a double cabin some time back and you want to know its fair value, but somehow you fail to find a fair value on market. You go maybe to the bond or to the car dealership and you'll get the cost of that new double cabin. Then you will less the accumulated depreciation in your books of that double cabin to get this amount of the depreciated replacement cost. Then that you will consider as your fair value. For example, if in your account, in your books, you have maybe accumulated depreciation of 20 million, and you go to the market, the new double cabin is costing you 100 million. So the 100 million minus the 20 million, 80 million. 80 million is the depreciated replacement cost of that double cabin, and that's what you take as your fair value. Hope that is quite clear. The frequency of valuation depends on the volatility of the fair values of individual items of property, plant, and equipment. So certain fair values are volatile. For example, land, people are like, land, the cost of land is just rising every day. So if it is really volatile, or sometimes some items, their values are either going down and up and down, like the market value. So you have to put that into consideration in order to determine the frequency of valuation. The more volatile the fair value, the more frequently revaluations should be carried out. Where the current fair value is very different from the carrying value, then a revaluation should be carried out. So in case you go to the market and they give you a fair value, for example, fair value of like 50 million, yet in your books you have a carrying value of 10 million, you have to go back and do some revaluation. That is a very, very big difference. Items within a class of property, plant, and equipment are revalued simultaneously to avoid selective revaluation of assets. That they've already indicated to us. One class, you have to do the entire revaluation for everything in that class. If an asset's carrying amount is increased as a result of a revaluation, the increase shall be credited directly to equity under the heading of revaluation surplus. However, the increase should be recognized in profit or loss to the extent that it reverses a revaluation decrease of the same asset previously recognized in profit or loss. We are going to look at an example, a practical example of that. So in case the carrying amount increases, we are going to see how we treat that in our books of account. It will affect our equity, it will affect our profit or loss. So if an asset's carrying amount is decreased as a result of revaluation, the decrease shall be recognized in profit or loss. However, the decrease shall be debited directly to equity under the heading of revaluation surplus to the extent of any credit balance existing in the revaluation surplus in respect of that asset. These adjustments are very common in number one, in case they bring consolidated statements. They are very, very, very common. So these two notes, that of the carrying amount increasing and the carrying amount decreasing, we are going to look at the numbers so that you're familiar with those adjustments. So let's look at one example. We are going to look at two examples. So let's look at example one. I'm going to give you some, like 2 minutes to read through. Then we are going to carry out the calculation together. In case you're done reading through, just notify me in the chat so that we can start working on the solution together. All right. Anyone else who's done? So are you able to see my Excel? Confirm in the chat. All right. So from our question, we are going to note the following points. Number one, that 2 years ago, the land had a carrying value of 15 million shillings. Had a carrying value of, 15 million. Then number two, we are going to note that a slump in the land values led to a revaluation loss, which is equal to an impairment loss. A slump in the land values led to a revaluation loss, which is equal to an impairment loss. Okay. And number three, impairment loss, impairment loss is equal to shillings 15 million minus shillings. Please, in the exam, you write the amounts in full, not 15M like I'm doing. 13 million, which is equal to shillings 2 million. So at this point, I think we are together how we are getting our impairment loss. That is the 15 million plus the 13 million, which we've been told is the current value of the asset. The number four, in the current year, the land has gained value. Okay, they've told us it has gained value. It's now 20 million. Thus, a revaluation gain of shillings 20 million minus shillings 13 million, which is equal to 17 million shillings. Remember when the period was beginning, they told us the land was 13 million, but at the end of the period, it has been valued at 20 million. So we are getting a revaluation gain. So another point to note, point 5, IAS 16 requires, sorry.
The difference is 7 million, not 17.
Sorry about that. Let me correct it. 7 million. So IAS 16 requires the above gain to be recognized in revaluation surplus account under equity. You remember, when there is an increase, when there is a revaluation gain, we are recognizing this as a revaluation supply under our equity. However, because of the impairment realized 2 years ago, a reversal of the impairment loss must be made before recognizing this gain in revaluation surplus account. So at this point, previously we had a loss, an impairment loss, or when we revalued, we got a loss of 2 million in the previous period. And we had our carrying amount of 13 million. So right now in this current period, we have made a revaluation gain of 7 million. However, there is an adjustment that we have to make in our statement. The revaluation loss is recognized in your profit or loss under your expenses. The 2 million is there. So we are going to make that adjustment in that statement. Therefore, the accounting entries will be as follows. So we are going to have our debit. So we are having our T account, debit and credit. In shillings. In shillings. So land account, that is in our statement of financial position. We just abbreviated statement of financial position or balance sheet. Will have $7 million. Then we shall have impairment loss account. That is in our, like I told you, profit or loss. We shall credit it. Shall credit it with 2 million. Because we are making an adjustment, this 2 million is coming in as an adjustment. So it's like this loss is being taken out. Because from our knowledge of financial accounting, our expenses have a normal debit balance. Now we are crediting the expense, which means we are decreasing that expense. Then revaluation surplus account in other comprehensive incomes. So you recognize this under your profit or loss under your other comprehensive incomes, but also in your equity. We shall credit 5 million, which is the difference between the 2 million and the 7 million. Sorry. So we shall have our 7 million and our 7 million is our total. So, are we together at that point? That's how we shall answer that question. Have you been able to note that? If you're done noting, please let me know. So that is our answer to the activity given. All right. So, my dear friends and colleagues, remember this is financial reporting. That's why we are doing all this rugambo. So these words that we are writing, the points to note, are the ones that are going to earn you marks, not the calculations. Because what the examiner wants to know is, do you understand this standard? The statements we've just gone through previously is what we are trying to break down in these explanations. So if you don't present the answers in this way, you lose marks. So this part here, this where you're seeing a lot of the storytelling is where the marks is. All right, is another person done? Before we move on, I just need just one other person to confirm, because also time is not on our side. We have some other things to cover quickly. All right, in case you're not done, we shall share the solution with you. So let's look at another scenario. We're going to look at another scenario. Just a minute, let me reshare my screen. Okay. So we are looking at another example where we are going to account for decrease in revaluation in the current year. So PFP company has an item of land carried in its books at 20 million. 2 years ago, this amount was revalued upwards to 25 million. The value of land has now decreased to 18 million. Account for the decrease in revaluation in the current year. Don't worry, the question, I have it somewhere in my Excel. Are you able to see my screen? All right. So our solution. So we are accounting for decrease in revaluation of a non-depreciable asset. IAS 16 requires that before an impairment, loss, or decrease in revaluation is recognized the entity must reverse the prior year revaluation gain. So this is the opposite of what we've done before. Therefore, the current year impairment loss of 7 million shillings which in brackets is 25 million minus 18 million must be offset against the revaluation gain of 5 million shillings that was recognized two years ago. Hopefully, you know how we came to that 5 million. That is the 25 minus 20. i.e., 2 years ago, revaluation gain is equal to 25 million shillings minus 20 which is equal to is M. So this is how we are going to recognize our, therefore, the accounting entries will be as follows. Shall have our debit and our credit. In shillings, in shillings. So our valuation account in our other comprehensive income will have $5 million. Then impairment loss account in our profit or loss will also have 2 million. Then our land account in our statement of financial position. Statement of financial position. Please write these things in full. I'm abbreviating them because I'm just being too fast here. We'll have 7 million. So we have our 7 million and 7 million. So that is the solution to our activity 2. Are we done sharing? Rather, are we done copying? All right. Okay. So let's quickly go through the remaining parts. Look at other scenarios. Revaluation and depreciation. An upward revaluation means that the depreciation charge will increase. Normally, a revaluation surplus is only realized when the asset is sold. but when it is being depreciated, part of that surplus is being realized as the asset is being used. The amount of the surplus realized is the difference between depreciation charged and the revalued amount, and the lower depreciation which would have been charged on the asset's original cost. This amount can be transferred to retained, i.e. realized earnings, but not through profit or loss. So we are going to look at an example of that quickly. Let me just take you through the solution quickly. Let me take you through the solution quickly. So ABC Uganda Limited bought an asset for 10 million shillings at the beginning of 2016. It had a useful life of 5 years. On 1st January 2018, the asset was valued at 12 million. The expected useful life has remained the same, i.e. 3 years remain, because they used 2 years, that is between 2018 and 2016. Required account for the revaluation and state the treatment for depreciation from 2018 onwards. So our solution is, let's look at the solution quickly. On January 2018, when the asset was revalued, it had a carrying amount which is our net book value of is historical cost, which is the cost of the asset minus accumulated depreciation. Sorry. Historical costs minus accumulated depreciation. So which is shillings, 10 million minus shillings, 10 million, which is 10M, over 5 years times 2 years. Hopefully we are together. So this is the 10 million shillings divided by 5 years is our depreciation over the years times the 2 years to get our accumulated depreciation. Okay. Historical cost 10 million minus accumulated depreciation. So, which is 10 million shillings minus 4 million shillings. So our net book value or carrying amount, rather the revalued amount, net book value is going to equal to 6 million shillings. What does this mean? Therefore, the revaluation gain is determined as below. The revaluation gain is determined as below. We get our debit, and credit. Shillings. So our accumulated depreciation account, which we normally account for, I think, in the statement of profit or loss, because it's an expense, will be debited because it's an expense, like I've said. It has a normal debit balance, 4 million. Then the assets account, which is in our statement of financial position. This one is in profit or loss. We have to show where we are taking it. Will be, 2 million, because it's an asset. It has also a normal debit balance. Then revaluation surplus account in our other comprehensive income. Income normally has a normal credit balance because it's a gain, so it is income in. So our accounts are balancing well, which is 6 million and 6 million. So there are some points to note quickly. So we need to note, number one, we need to note that upon revaluation, the assets accumulated depreciation is reversed, like we are told in the statement before. Since the asset now has a new value and its accumulated depreciation no longer needs to be held in the books. Then from 2018 onwards, i.e. for the next 3 years, the depreciation will be equal to 2 million, 2 million, sorry, 2 million, sorry, will be 12 million, sorry, 12 million divided by the 3 years, which is equal to 4 million shillings. Per annum. So that is depreciation per annum. So there is also another note to note: transfer of realized revaluation gain. Transfer of realized revaluation gain. All right. So IAS 16 requires an entity to transfer the realized revaluation gain at the end of each accounting period. So this is determined as below. This is how we are going to determine it. Realized revaluation gain is equal to depreciation on revalued amount minus old depreciation charge. Which is 4 million shillings minus 2 million shillings. And it gives us 2 million. Let's write it like size shillings, 2 million. So therefore, the accounting entries will be as follows. Will be as follows. Shall have a debit, then credit. Shillings and shillings. So we have a revaluation, surplus account of 2 million. Then retained earnings account. Retaining earnings is normally in balance sheet in the statement of position under equity. 2 million. So, which gives us a total of 2 million. Total of 2 million. So our last note will be this is a movement on owner's equity only, and it will be shown in the statement of changes in equity and not through profit or loss. So this change has to only be recognized under the changes in equity, not profit or loss. So that is our solution to our activity 3. So as we conclude, let's quickly look at depreciation. Each item of property, plant, and equipment shall be depreciated. Depreciation charge for each period shall be recognized in profit or loss. As we know, depreciation is an expense. The depreciable amount of an asset shall be allocated on a systematic basis over its useful life. That one we are very conversant with. Even our knowledge of financial accounting helps. The residual value and the useful life of an asset shall be reviewed at least at each financial year end. And if expectations differ from previous estimates, the change will be accounted for as a change in an accounting estimate in accordance with IAS 8 accounting policies, changes in accounting estimates, and errors. The depreciation method used shall reflect the pattern in which the asset's future economic benefits are expected to be consumed by the entity. The depreciation method applied to an asset shall be reviewed at least at each financial year end, and if there has been a significant change in the expected pattern of consumption of the future economic benefits embodied in the asset, the method shall be changed to reflect the changed pattern. Such a change shall be accounted for as a change in an accounting estimate in accordance with IAS 8. So in case of any changes, we need to recognize using the standard of IAS 8. So there are instances where we have to derecognize property, plant, and equipment. The carrying amount of an item of property, plant, and equipment shall be derecognized A, on disposal, when we dispose of the asset. B, when no future economic benefits are expected from its use or disposal. The gain or loss arising from the derecognition of an item of property, plant, and equipment shall be included in profit or loss when the item is derecognized. Gains shall not be classified as revenue. Okay. If an entity recognizes in the carrying amount of an item of property, plant, and equipment the cost of a replacement for a part of the item, then it recognizes the carrying amount of the replaced part, regardless of whether the replaced part had been depreciated separately. The gain or loss arising from the derecognition of an item of property, plant, and equipment shall be determined as the difference between the net disposal profits, if any, and the carrying amount of the item. So basically, like we've seen throughout the session, these items have carrying amounts. So at that time of disposing of the asset or derecognizing, the proceeds we get from that asset, the difference between the two, the carrying amount and the proceeds, will either give us a loss or gain on disposal. So impairment of property, plant, and equipment. Impairment as defined by IAS 36. So we shall be looking at this standard separately. Impairment of non-current assets is a situation that occurs when the recoverable amount of an item declines below the carrying amount. So we looked at the recoverable amount, which is the higher of fair value less cost to sell or value in use. The type of events that could lead to an impairment of an asset could be either external, internal, or any other events. So we have external factors that can lead to impairment, significant decline in market value, adverse change in technology, economic, market, legal environment. So those are kind of straightforward. Then we have some internal factors where machines or properties are damaged or become obsolescence, plans to discontinue or restructure operations, like the property, plant, and equipment is no longer needed because there is restructuring. Economic performance of the machine is worse than expected. Like you might have bought it or acquired it expecting something from it, some good production, but it is not producing what you expected. Other factors include cash flows for acquiring an asset or operating or maintaining it are significantly higher than budget. The expenses are too much to operate. So finally, we shall look at the disclosures of our standard, which we need to note. But we are going to share these notes with you. You'll be able to capture them. The financial statements shall disclose for each class of property, plant, and equipment the measurement bases used for determining the gross carrying amount, the depreciation methods used, the useful lives of or the depreciation rates used, the gross carrying amount and the accumulated depreciation that is aggregated with accumulated impairment losses at the beginning and end of the period, a reconciliation of the carrying amount at the beginning and the end of the period showing additions, assets classified as held for sale, acquisitions through business combinations, increases or decreases resulting from revaluations and from impairment losses recognized or reversed directly in equity, impairment losses recognized or reversed in profit or loss, depreciation, and other changes. The financial statements shall also disclose the existence and amounts of restrictions on title and property, plant, and equipment pledged as security for liabilities. Yes, sometimes entities and businesses will give in as their property, plant, and equipment as collateral to money lenders or banks or what. The amount of expenditures recognized in the carrying amount of an item of property, plant, and equipment in the course of its construction, and the amount of contractual commitments for the acquisition of property, plant, and equipment. If items of property, plant, and equipment are stated and revalued, amounts the following shall be disclosed: the effective date of the revaluation, whether an independent valuer was involved, the methods and significant assumptions applied in estimating the item's fair values, the extent to which the item's fair values were determined by reference to observable prices in an active market or recent market transactions, or were estimated using other valuation techniques. For each revalued class of property, plant, and equipment, the carrying amount that would have been recognized had the asset been carried under the cost model, and the revaluation surplus indicating the change for the period and any restrictions on the distribution of the balance to shareholders. So you go back and read through these disclosures for each scenario, then make a summary. We shall also share with you the summary of the standard. You're always advised to try to summarize these standards for easy revision and for you to remember certain points. But I repeat to emphasize, this is financial reporting. The way you've seen us handle the question, the solution, is the way you're supposed to systematically answer it if you want to really get some good marks in the paper. Thank you very much for today. Sorry, the class has been longer than usual, but the standard also is big and also important because it comprises a lot of information that will also be needed in other standards that we are going to look at, but also in the consolidated, in the group accounts. The group accounts, it's a common area that is examined. Thank you very much and have a blessed night. Sorry about the speed. We are going to share about that. We are going to share the notes. So in case there is something you have not understood, please let me reshare my contact. 390504. All right. Just in case you have a question, just inbox me.